let's just start out by looking at TNX, which are the 10-year yields, and maybe that's always the best place to start when you're doing bond market analysis. And you can see in here what we're looking at. I'm just going to show you the side-by-side right over here, is that there is likely some timeout here to the trough that's due in the third week of January. Now, here's where that trough is due here, also in the third week of January. We thought that it would get down only to about 4.06, which was right around this line right over here, right in the middle there. And you can see it got weaker. And you had this really weak translation on this cycle where it went up 3 days and then came down. This will be updated for our level 3 and 4 members, for our chart members, in the next several days, because this is a slight change where we identified the translation because this ran so much past the bottom. And now this points out over here into the third week of January. Here is this low due over here on the weekly in the third week of January. This says the bond market is likely to stay on the firm side, or the yield market stay on the weak side, for probably another few weeks. And then after that, we get this move and rebound on the upside over here with the Treasury futures trough due in March. In other words, when I switch over now to let's just look at ZNs, and I'll keep this in the notes since I was looking at 10-year notes. It says to me that there's likely to be a decline and a trough in the 10 years. And we'll just blow this up here. And you can see in here that these cycle patterns are pointing to a downward move in here into these rising supports into this period in March. So there's a trough due here in March. There's a peak due in yields in March. And this is the time frame when you should get a move up in interest rates, a move up in the dollar as a rebound, and maybe that some softness out in the metals, giving us what I think is a buying opportunity. Now, the original analysis was that this would come back down to these lows. This is giving us an indication, unless inflation picks up and there's this very sharp decline, that this is going to be an oddly formed dominant cycle without the last minor cycle making a lower bottom. That would be a very unusual shape, with still a possibility that this ends up coming down into these lower levels out over here. But that would really take some surprise that the Fed is not going to be able to cut rates the way everybody is looking at. But either way, what we're looking at is a decline in here in the notes in the bonds out into that March timeframe, which aligns with the rally in yields out into that March timeframe. So that's my look at the bond market. And